This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 22, 2026, and this is the London session. Now, let's get into it. Markets are screaming for shelter. Gold has just punched through the 4,130 mark, pushing gold to $4,130.72, a level that demands attention. Meanwhile, the Fear and Greed Index is flashing a stark 14 out of 100 fearful territory. We are in a classic risk-off environment where the US dollar is the king, and the rest of the global currency complex is paying the toll. Let's look at the tape as of 9:30 ET. Looking ahead, the calendar is light on data, heavy on implication. On Thursday, July 23rd, we have U.S. weekly jobless claims. In this environment, any surprise in initial claims could sharpen the focus on the labor market's cooling pace versus sticky inflation. Later in the week, on Friday, July 25th, and Monday, July 28th, we'll see repeated GDP Now estimates. These revisions act as a barometer for whether the market believes the economy is softening fast enough to force the Fed's hand. And finally, the big picture event. Tuesday, July 29th, the EFFOMC rate decision. That is the horizon we are watching.
With the EFFOMC on July 29th, the jobless claims become the leading indicator. If claims drop, it reinforces the Fed's higher for longer stance. If they spike, it gives the market hope for a pivot, even if inflation says otherwise.
Here is the snapshot as of 9:30 ET. The dollar is broadly stronger. Dollar-yen is trading at $163.16, very close to its 24-hour high. Euro-dollar is languishing at $1.14, testing the lower bounds of its recent range. Cable is holding steady at $1.33, but it's not leading the charge. Commodities are mixed. Gold is up $1.23% to $4,130.72, while silver sits at $59.78. The VIX is at 18.65, not exploding, but the underlying sentiment is brittle. The Directorate's brief notes a geopolitical shock driving this safe haven rally. Pulse, walk us through the macro disconnect we're seeing right now. We need to contextualize this move. The headlines are dominated by escalating tension. First, Trump stated, if Iran fires at a ship in the Strait, the U.S. will bomb a bridge. Second, European markets wrapped with oil prices ramping higher as conflicts expand. Third, U.S. Secretary of State Rubio noted Iran is in a lot of trouble. The result? Oil prices extending gains as Strait of Hormuz disruptions worsen. CIPHER, how is institutional money reacting to this specific geopolitical noise?
It's a structural shift, not a knee-jerk reaction. Look at the CFTC commitments of traders' data. Leveraged funds are holding a staggering negative 90,461 net contract short position in yen. They've added 91,732 contracts to that short bias this week alone. Simultaneously, asset managers are shorting Canadian dollar with a net negative 106,487 contracts. Money is fleeing commodity currencies and the carry trade yen because the geopolitical risk premium is being baked into the cost of carry. The flow isn't random. It's hedging against supply chain fractures.
So we have massive short positioning in yen and Canadian dollar. Does that make those pairs safer or riskier if the situation de-escalates?
Extremely risky. That is the definition of a crowded trade. If the rhetoric cools even slightly, those shorts have to unwind rapidly. But right now, the data supports the safe haven bid into dollar and gold.
And on the flip side, Aussie dollar is at $0.69, near its lows. Yet, CFTC data shows leveraged funds are still strongly bullish Aussie, with a positive 27,222 net position. What do you make of that divergence?
That is a lagging indicator. Price action is currently crushing those longs. Until Aussie dollar finds a floor, that bullish positioning is just paperweight waiting to be squeezed. The market is telling us that geopolitical fear overrides current account fundamentals right now.
Let's dive into the leader of the pack, gold. Gold is at $4,130.72, up 1.23%. Grid, break down the technical structure of this move.
Structurally, we have broken out. The psychological and technical barrier of 4,130 has been breached. Price closed at 4,130.72, pushing off a previous high of 4,087.47. The 5-day range tells the story of momentum. We moved from a low of 3,959.64 to a high of 4,141.9. That is an expansion of nearly $200 in 5 days. We are currently testing the upper boundary. My reading is breakout continuation. The structure is no longer consolidating, it is trending.
I have to challenge that purely technical view. You're looking at the chart, but you're ignoring the real yield ceiling. Core PCE is at 3.41%, and the 10-year yield is sitting at 4.6%. Holding non-yielding gold in this environment usually gets punished by opportunity cost. The fact that gold is rallying despite sticky inflation means this isn't a standard macro trade anymore. It's a war risk premium. The fundamentals don't support this level unless nominal yields collapse, which the Fed explicitly forbids.
Which is why I'm focusing on the price action pulse. The market is voting with its wallet, not your inflation model. The break above 4,130 is confirmed by volume. The resistance is clearly at the 5-day high of 4,141.9. If we hold above 4,130, the path of least resistance is up until we hit that 4,141.9 ceiling.
I agree with Pulse that the fundamentals are stretched, but I'd go further on the risk. Look at the VIX. It's at 18.65. It hasn't spiked, yet the fear and greed index is at 14. This compression is dangerous. We are pricing in a slow bleed scenario. If VIX cracks below its 5-day low of 15.64, we won't see a slow fade. We'll see a volatility explosion that could reverse these flows instantly. The current gold breakout looks pristine, but it is built on quiet options markets. One sharp move in equities could trigger a margin call cascade that sells gold alongside stocks.
So we have a technical breakout challenged by macro constraints sitting atop a fragile volatility structure. Who else is benefiting from this dollar strength? Let's look at dollar yen. Dollar yen is at $163.16. Grid, where are we technically?
We are in a tight consolidation zone. Dollar yen is trading at 163.161, which is only 0.0785 pips away from its 5-day high of 163.2395. The range is 162.128 to 163.2395. We are essentially pressing against the upper rail. This is a boundary hold. If we close a daily candle above 163.2395, we open up space. If we reject, we snap back toward 162.128. Right now, the data shows a boundary hold, meaning buyers are defending this upper limit aggressively.
And remember who is standing behind those bids. As I mentioned, leveraged funds are short 90,461 yen contracts. Those shorts are being protected and reinforced by spot buying. The flow is supporting the technical break. However, the fragility is high. Because of that massive short positioning, any dip below 163 could trigger algorithmic covering that accelerates the move upward.
But consider the Bank of Japan context. Officials recently stated they see recent yen weakness as an upside inflation risk and are open to raising rates faster. At 163.16, the Bank of Japan is looking nervous. The fundamental pressure is building on the yen from the domestic policy side, even as geopolitical fear pushes dollar higher. You can't ignore the central bank divergence. The technical breakout, at 163.23, is facing a wall of potential intervention chatter. So we have a technical squeeze meeting political friction. Let's pivot to the euro, which seems to be the casualty of this flow. Euro dollar is at $1.14. Grid, you flagged this earlier.
Yes, euro dollar is compressing into the lower bound of its 5-day range. The low is 1.13973. We are currently at 1.14069, which is mere inches away from that support. This is a critical juncture. If 1.13973 fails, we see acceleration downward. The structure is weak. it is failing to find liquidity at the mid-range, dropping straight to the floor. My read is that unless we reclaim 1.142, the path of least resistance is toward testing and breaking 1.13973.
I challenge the idea that this is just a technical test. This is a structural decay. The VIX is suppressing the cost of carry for longs, but the fear and greed index at 14 tells me retail and institutional risk appetite is evaporating. Euro-dollar is a proxy for global growth optimism. When sentiment hits 14, the euro is the first to get sold because it offers neither safety nor yield in this specific geopolitical climate. Breaking 1.13973 isn't just a technical loss. It's a confirmation of the risk-off regime.
Connecting the dots here. Grid sees the technical breakdown at 1.13973, and SPECTER identifies it as a sentiment-driven capitulation. But remember CIPHER's point on flows. The dollar strength is broad-based. DXY is up 0.2% week over week to 120.53. So even if euro-dollar holds 1.13973 temporarily, the numerator dollar is getting stronger everywhere. The breakdown is likely inevitable unless the geopolitical headline risk fades, which it isn't.
We've looked at gold's breakout, dollar-yen's boundary hold, and euro-dollar's technical stress. Apex, bring it home. Where is the market right now?
The market is in a state of controlled dislocation. Pulse highlighted the macro trap. Inflation at 3.41% prevents the Fed from cutting, so the dollar remains structurally strong regardless of equity fear. Grid identified the technical triggers. Gold needs to conquer 4,141.9, and dollar-yen is betting on 163.2395. CIPHER reminded us that the yen short squeeze is the engine powering much of this move, making it volatile. SPECTER warned that the calm VIX is a lie, the risk is asymmetrical. The consensus view is long dollar and gold, short risk assets. The question is not if the trend continues, but when the overcrowded trades begin to unwind. For now, the data supports the safe haven bid.
Key takeaways for the North American session. First, gold has broken 4,130, but the 4,141.9 level is the new immediate resistance. Second, dollar-yen is testing its 5-day high of 163.2395, supported by massive COT short positioning. Third, euro-dollar is flirting with its 5-day low of 13,973, a level that defines the current euro weakness. Tomorrow, watch U.S. jobless claims to see if the labor data supports the Fed's hands-tied posture. Stay disciplined, manage risk, and we'll see you at the next pre-market. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.